Chinese have completely grind their imports to a halt in August. We expect also very low imports of US crude oil into China next month.
The Gulf Coast of America, once a bustling hub of global energy trade, has gone eerily quiet. And it's not just the sound of the waves fading. By August 2025, China, the world's largest oil buyer, has all but wiped US crude from its import list. From a steady flow of 100,000 barrels a day to a trickle that's barely a whisper, this shift didn't come with a grand announcement or a fiery speech, just a 10% tariff and a wall of silence. While Beijing was busy locking in deals with Russia, Iran, and the Middle East, the White House was caught in a time warp, shouting about tariffs and wind turbines like it's still 2018. Ports in Texas sit half empty. Pipelines hum at a fraction of their capacity, and the self-styled master dealmaker in Washington is too distracted by fights over Canadian lumber to see the bigger picture. This isn't just about losing a customer, it's about America being outplayed in a game it thought it controlled, left preaching to an audience that's already left the room. Not so long ago, American oil was a prized commodity in China. Those 160,000 barrels a day weren't the whole story, but they were enough to justify billions poured into Gulf Coast infrastructure, expanded terminals, new pipelines, tankers lined up like delivery trucks outside Houston refineries. It was a system built on the promise of China's insatiable demand, a partnership that kept the oil flowing and the dollars rolling. Then, in February 2025, China quietly imposed a 10% tariff on US crude, and the orders stopped dead. No formal ban, no public feud, just a cold, hard pivot. Even bargain-priced barrels couldn't tempt Beijing back. Now, storage tanks in Corpus Christi are gathering dust, and pipelines built to feed Asia are pumping into the void. This wasn't sabotage, it was a calculated move. While Washington's leader was tweeting about trade wars and imaginary enemies, China was redrawing the global energy map, leaving America off the guest list. This loss cuts deeper than a few missed shipments. It's about trust and relevance. The US used to be the heart of global trade, the go-to middleman everyone relied on. But when you start slapping tariffs on your partners, they don't just fight back, they find a way around you. Take Canada and Mexico, our closest neighbors, who are now pouring $120 billion into the Northern Corridor, a trade route that bypasses US ports entirely, funneling goods through their own Pacific and Atlantic hubs. It's a clear signal: keep the supply chain moving, just not through America's backyard. The world isn't slamming doors in our face, it's quietly locking them and tossing the keys. The White House, still chanting "America first," hasn't noticed the seats are empty. This isn't just a lost deal, it's the slow unraveling of America's reputation as a partner you can bank on. So, what did China do after turning its back on US oil? They didn't waste a second. By mid-2025, Beijing had inked long-term contracts with Russia, Saudi Arabia, the UAE, and Iran, securing millions of barrels at prices that undercut American crude. The real sting? Not one of these deals was paid in dollars. Every contract was settled in yuan, China's own currency, effectively sidelining the greenback. This wasn't a quick patch. It was a full rewiring of their energy system. Ports, pipelines, refineries, and payment networks all reconfigured to handle Middle Eastern and Russian blends. It's like upgrading your entire tech setup and throwing out the old cables. Even if US oil dropped to pennies on the barrel, China's infrastructure isn't built to take it anymore. The ports don't match, the refineries aren't set up for it, and the political will is long gone. America's crude is a relic in a system that's moved on. While China was busy rewriting its energy playbook, Washington was stuck in a loop of its own making. The president, who once claimed he could outdeal the world's oil giants, was too busy railing against Canadian lumber prices and windmill conspiracies to notice the tectonic shift. Ports in Houston and Corpus Christi, built to serve China's hunger, are now shadows of their former selves. Cranes sit idle, and storage tanks that once turned over weekly are half full at best. Billions were invested in terminals and pipelines to ride the wave of energy dominance, but that wave has crashed. Exporters are scrambling to pivot to Europe, India, or South America. But let's be honest, nobody matches China's scale or spending power. This isn't a supply chain hiccup, it's a business model breaking apart, driven by arrogance, miscalculations, and a White House that thinks tariffs are a magic wand. The reality? They've left America with docks to nowhere, and a narrative of victory that nobody's buying. The shift isn't just about oil, it's about power and money. By July 2025, most of China's oil contracts with Russia, Saudi Arabia, and the UAE were priced in yuan, not dollars. Every barrel settled in China's currency chips away at the dollar's grip on global trade, weakening America's ability to wield sanctions or dictate terms. It's a slow, deliberate cut to the financial arteries of U.S. influence. Iran's in on the game too, funneling millions of barrels to China's small, nimble teapot refineries through a shadow fleet of tankers with fake flags and forged papers. By mid-2025, Iran was shipping 1.7 million barrels a day to China, 10 times what the U.S. used to supply. While Washington tried to box Iran out with sanctions, Beijing rolled out the welcome mat, turning America's pressure tactics into a bad joke. The president called the yuan funny money at a rally, but the rest of the world's starting to call it the new normal. This isn't just China rewriting the rules. Others are joining in. India, a major oil player, signed long-term deals with Russia in July 2025, settling in yuan and using old Soviet-era routes to dodge choke points like the Strait of Hormuz. Southeast Asian countries like Malaysia and Thailand are shifting their oil purchases to favor suppliers who don't demand dollars. Even Europe, still buying some US crude, is leveraging the new competition to negotiate better prices, insurance breaks, and longer payment terms. The energy game America once dominated is now being played with someone else's playbook. Pricing systems, shipping lanes, and alliances are being redrawn, and the US isn't the one holding the marker. This isn't a glitch in the system, it's a global restructuring, and America's not calling the shots anymore. Back on the Gulf Coast, the fallout is stark. Export terminals built for China's demand are running at half speed, their cranes frozen like overpriced statues. Offshore rigs are slowing, and contracts once written in English now come in Mandarin or Arabic. Billions spent on energy dominance are turning into a monument to bad bets. The White House keeps preaching independence, but it sounds more like a tired speech nobody's clapping for. The president's out there, blaming wind farms and foreign leaders, insisting America's stronger than ever. But strength doesn't mean much when your biggest buyer's gone and your allies are building trade routes that don't need you. The world's moving on, and the US is stuck yelling at a screen that's already gone dark. China's not just buying from new suppliers, they're preparing for a future that doesn't include US oil. By mid-2025, Beijing's strategic petroleum reserves were stocked to cover over 3 months of imports, far exceeding global benchmarks. Russia, Iran, and Saudi Arabia are filling those tanks, not America. This isn't just about having a rainy day fund, it's about building leverage. With full reserves and yuan-based deals, China can ride out market swings or US pressure without blinking. Meanwhile, Congress is still bickering over whether to refill America's own strategic reserves, assuming anyone can find the budget. Denial seems to be the only thing flowing freely in Washington. While China's bunkers are brimming and its trade lines are thriving, this wasn't a dramatic showdown. No sanctions, no summits, just a quiet retreat. The world didn't shove America out, it just stopped sending invitations. Canada's redirecting oil to Asia and Europe, citing US trade volatility, per Reuters' July 2025 report. Mexico's all in on the northern corridor, bypassing US ports. The silence speaks louder than any headline. No one's burning flags or firing shots. They're just signing contracts we're not part of. America's energy strategy, once sold as a path to global dominance, is starting to look like a solo performance with a dwindling crowd. The White House keeps shouting about victories, but the deals tell a different story. One where America's signature isn't required. The real cost isn't just barrels or bucks, it's influence. Power doesn't disappear in a single explosion. It fades when people stop needing you. China didn't slam a door, they built a new system with locks we can't pick. Canada, Mexico, India, and others are following suit, finding ways to trade without us. While Washington's caught up in culture wars and old grudges, the world's rewriting the rules of energy and finance. This isn't about one bad tariff. It's about a string of choices that's left America on the sidelines. What happens when the world gets comfortable without us? The answer won't come in a tweet or a soundbite. It'll come in empty docks, silent pipelines, and contracts we're no longer asked to sign. So, what's your take? Is this a temporary stumble, or the moment America's energy dominance slipped away for good? Drop your thoughts below, because this story's about more than oil. It's about a world that's learning to live without us.